Welcome to Trading Nation. Pleased to be joined once again by Jeff Saut, Chief Investment Strategist at Raymond James. Jeff, you've been bullish and you've been right. But at some point, even the biggest bull like you has got to start questioning the strength of this rally, does he not? Or do you think that momentum will beget momentum and we'll just keep on going?
Well, our short-term model and intermediate-term model that have been very bullish since the beginning of November have targeted the first part to middle part of February as potentially the first point of vulnerability. So we'll probably trim a few positions going in to February, but I still think the secular bull market's got years left to run. The economy is stronger than a garlic milkshake. Earnings are coming in better than people think. There's not a whole lot to see that could go wrong with this, Brian.
Well, a garlic milkshake sounds pretty strong, but it also sounds like something that can make you sick. Is there anything that you would worry about with the economy? I mean, is there maybe inflation is that sort of that thing that we have to worry about? No?
Yeah, well, inflation has picked up a little bit, but it's nothing to be worried about as of yet. Inflation's going to come back. You can't find any economy in the world that has had this much cash thrown into it and not had inflation come out the back. I just think it's going to be very slow, just like interest rates are going to go up, but I think they're going to go up at a glacial pace. And I just don't see, a geopolitical event or a huge policy mistake in D.C. I just don't see what derails this secular bull market.
Let's talk about your indicators. You said you're bullish, yes, but middle of February, maybe you take some stuff off the table. What are you seeing, and what would you take off the table?
Well, I'm pretty much overweight technology, so I'd probably trim some of those positions. I'm probably not going to take anything out of financials because financials relative to the overall market are not that expensive. I did make a call a few months ago. If you look at the ratio chart between the CRB, the Commodity Research Bureaus, and divide it by the S&P 500, you'll see that commodities over the past 3 months are as cheap relative to stocks as they have been since the 1970s. So we've been wading up into what I would call stuff stocks.
Like stuff stocks, like, I know you're not going to name individual names, so I'm just going to, you can nod or whatever, like a Freeport, McMoran, like companies that dig stuff out of the ground, make stuff, turn their stuff into other stuff. Is that what you're talking about?
Yeah, master limited partnerships, soybean, fertilizer, things like that. Things, as my friend Dennis Gartman would say, if you drop them on your foot, it hurts.
We take a lot of soybeans for that, but I certainly get your points here. I like this. We're going back to the agricultural world. Does that mean that big tech's best days are behind them, or does it just mean that this group is attractive as well?
This group is attractive. It's under-owned, under-loved. It's like the midstream master limited partnerships. They got sucked down when the upstream MLPs blew up, and they don't really have the price sensitivity to crude oil. It's like owning a transportation company without wheels. They own the pipes and the storage facilities. So we bought a lot of those in tax loss selling season.
Yeah, and you think they'll remain attractive for a while?
I do.
Yeah, are you surprised by the strength of the global economy? And the only reason I ask that, Jeff, is or I should say the global markets. Like China, we did an additional segment on Trading Nation that shows the Chinese market's up 10 days in a row, the FXI rather, a big ETF. It said all this hyperbolistic stuff. Europe has done well, better than us in some cases. I guess my confusion, having done this now for about 20 years, is I just don't understand where the money is coming from. There has to be buyers, which means there has to be incremental dollars still out there. Well,
you saw maybe a year ago, you saw the largest pension fund in the world, Norway's almost $1 trillion pension fund, say the only way they can get back to their targeted return is to put more money into equities. And so they went from 60% long equities to 70% long equities. About 2 months later, Sweden did basically the same thing. It's dawning on endowment funds and pension funds and sovereign wealth funds that the only way you can get back to targeted returns is to own equities. And you've got fewer equities. You're down from about 9,000 equities 20 years ago to about 5,000 equities now. So you've got more money chasing fewer stocks. Yeah, and a lot of those equities you mentioned, Jeff, and this is a topic I've been hot on actually, aren't big enough for a lot of these funds to own. So when you take a look at the world of ownable stocks, I think it's, don't quote me on this, down about half since you and I first started talking 15 plus
years ago. You think that's a big, and if we, and tax reform with this repatriated money, probably taking a lot more stock off the shelf with buybacks. Is that a big part of your thesis?
Well, that's part of the thesis. I mean, the tax cuts for every 1 point drop in the corporate tax rate, it hypothetically adds $1.31 to S&P earnings. So you see the consensus estimate now for this year is up to $151. And I saw one bulge bracket firm, I think it was UBS, put out an estimate of $157. So again, I don't see a whole lot that could derail this secular bull market.
Jeff Saut, Chief Investment Strategist at Raymond James and connoisseur of the garlic milkshake. Jeff, it's always a pleasure to chat with you, my friend. Thank you very much. We appreciate it.
You bet.
Thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.